Hi, welcome to Academic Market Insights. I'm Professor Dr. Rhodes from the Kelley School of Business. And as always, I'm joined by Dr. Alpha or Dr. A. We're working on nicknames, etc. Uh, Today's her turn to teach, and I get to play student and maybe barge in with some questions. But I think today we're going to talk about asset allocation as you get a bit older in life. We're typically talking to college students, and when they ask me about asset allocation, I say, you got a long time frame. You can take on a lot of risk. Go buy Bitcoin. I don't say that part, but but they can handle a lot more risk because they've got a lot more earning power than maybe people, in the last decade or so of their careers. So with that, I'm going to pass it over to Dr. A. She's going to put those slides up and tell us why we're talking about asset allocation near retirement today.
So first, if you like this program, please hit subscribe and please hit like. My 7-year-old is super into those likes. So even if you don't like it, you can lie and say you like it because he'll get a big kick out of it. And
See
it's
how many we get. So
um, yeah, and we're talking about asset allocations because one of our friends has commented she's getting closer to retirement. What does somebody in my situation do? Especially given that the last week or 2 weeks ago, we spoke about the animal spirit. Last week, we talked about the future cast. This isn't a traditional market environment, especially for those in the near term who are looking to retire in the near term. And I do want to put a little shout out to this wonderful woman. I've known her for almost 10 years now, and she has really helped me think about people a little bit differently and see people more as individuals. I think particularly as economists and people in the financial markets, it's so easy to aggregate people up into different classes, not necessarily social classes, but but almost like asset classes, right? When we think about high risk tolerance, we think about this, we think about that, and we group everybody together, but really everybody's an individual. So when we start to think about asset allocation, it's a very personal decision because we're thinking about things such as your risk tolerance, your financial goals and objectives. Again, oh, and I don't have my Michael Jordan. Oh, I have my backpack really quick. And if you're Michael Jordan, your goals for rate of return might be very different than somebody who is graduating from undergrad, right? So we have different goals, we have different risk tolerances, and we also have different unique situations. So in the last slide that we're going to talk about today, we're going to talk about what to do with your home. Because if you're thinking about the average or traditional American who's getting ready to retire, that's going to be one of your largest assets. And the decision of whether or not you to keep that asset, to downsize, to pay cash for another house, all of those are very personal and important decisions, especially when you're thinking about retirement and especially in our wonky environment, because we looked at the yield curve and we'll look at the yield curve again today. Okay, having said that, let's jump into the slides. Asset allocation. And I really
we get
do,
so excited about the goofiest things.
it's a fun topic, right? And I do really appreciate this friend who's really helped transform the way I think about individuals. Let's move this so I can share the whole thing. Russell, have you ever seen the movie The Company Men? It was about a group of professionals who were in the 2008 crash. Ben Affleck's in it, Kevin Costner's in it, Craig T. Nelson's in it. There's a huge cast of characters, and Ben Affleck's character gets let go from his job, and he's forced to move in with his in-laws. And you see him kind of go through this demise. And at one point, he pulls up to the country club and they tell him, you can't come in here anymore. And he's freaking out to his wife. And she says, well, I had to cut the country club membership because we don't have any money. And then, oh, his Porsche was repossessed and he had to, I know, it was terrible. But again, these are individuals, and it's fun to sometimes pick at, these stereotypes, but these are individuals with a family who there's major consequences to things like the 2008 financial crisis. And I hope that's the last soapbox that I get on today, but I make no promises.
You never know.
You never know. Okay, so we're going to talk about what we would think about with regards to a traditional asset allocation. We're going to talk about the wonky environment, which is a theme that we've been interweaving the last couple of weeks. And then what do you do if you're at that moment thinking about retiring in the next 3 to 5, even 10 years? What do you do with some of your assets? And again, part of that is going to be, what are some of your goals? Okay, so this is a traditional asset mix. So the idea, when you are young, you're going to take on more risk and you're going to invest more heavily into the stock market. And then once you're beyond 50, which I don't know, feels so young now. This
You've
is
still got, if you're 50, you've still got 20 years of work
of work.
still. So you know, I these are good benchmarks to start with, depending on your risk tolerance. We'll
Right.
say that.
But it feels old. Like this feels like an old model, like that this is really not what people are doing anymore. And the old rule of thumb is you start to move away from those riskier assets such as equities, and you moved into bonds. One of the reasons, and when I jump to our yield curve, this was taken the Fed funds target range on the 7th. If we were to put in a normal yield curve, we're going to look something more like this. And so getting back to the idea of our 80-20, even if you've got 20 years left of an investment, you could theoretically still have a decent rate of return and lock that in for 20 years. It's not going to be super sexy. It's not going to be super exciting, but it's going to be most likely a guaranteed rate of return, especially if you're looking to invest in something such as a AAA bond or a government bond. You're guaranteed. Now, the challenge in the last 15 years, and correct me if I'm wrong if you disagree with this, if this is a normal curve, our curve might have looked a little more down here. So when we think about those rates of returns, even once you start to get out to 20 and 30 years, you're not really seeing that time value. You're not getting that return that you're hoping for. So if you're investing in 80%, and let's say you're getting 2% on your bond, and you've got 20 years left, that's not very exciting. And it's most likely not going to achieve the financial goals you have set. Also, one of these things that this traditional asset allocation model ignores, in my opinion, is the impact of inflation.
Yeah.
So
Yeah.
we've had decades of very
Yeah.
low inflation. I know we had inflation in the 70s and in the early 80s, but then decades of very, very low inflation. We didn't see those changes in prices. We didn't have that price increase. So we weren't competing with it. Now we're in an environment where we have inflation. So if you're locked into a very low rate and for 20 years, 30 years, you're actually losing value because it's not even keeping up with inflation. So when we think about our traditional asset allocation, and this would be something that we would teach, or I feel like I've even taught this model in a basic financial markets class in undergraduate, like this specific model. So um, here's another model, and I wanted to throw in a couple different types of asset allocation. Again, this is your basic. This is what I would teach in the Introduction to Financial Markets class, which would probably predicate a corporate finance class. It's very basic, but it's something you can wrap your mind around. Now we're starting to get into a little more, how can you say, variances into what types of bonds or what types of assets that we should be investing in. So again, very conservative, being 100% cash. And that's very different than even what this model is saying. There's no cash in this, it's just bonds or equity. And this model goes all the way up to 100% in bonds. I want to,
Bucks.
this came from Retirement Visions. So this is giving us also the rate of return in 2021. So you can see that the return for cash was 0.04%, versus in the year 2021, if you were invested in 100% stocks, you're looking at 28.7%. Now, again, everything needs to be put into context. 2021 was an amazing year for stocks. It was a beautiful, beautiful, beautiful bull run. So we had just come out of COVID. There was pent-up demand. Prices were a little bit higher, but people were ready to buy, and they did. And the stock market just blossomed. The long run average for the S&P 500 is around 10.5%. So we're looking at this beautiful rate of return of 28.7% for 2021, but we need to keep remind ourselves that that's specific to that particular time period. So we couldn't necessarily expect that going forward. And we talked 2 weeks ago about the idea that that probably won't happen in 2025, that we could be in a situation where the stock market is going to be stay flat, maybe rise a little bit, but there's a decent probability that it'll actually decline in value. Okay.
So
Uh,
I can't raise my hand like you can when I host.
oh,
So I'm gonna have to start doing this. That's what I've been looking around for. Um, the go back to the just go back one or two to the age one right there. I've seen this one before. I think one that's more appropriate is subtracting your age from 100 to get your
mm,
equity debt breakout. I've seen that before where, it if I'm right out of college and I'm 25, that the base to start with would be 75% stocks, 25% bonds. But if you're more aggressive, if you've got a high paying job, et cetera, you might lend yourself more to equities than bonds. And I actually encourage a lot of undergrads to favor equities over bonds for the long term, just because they have a long time period to regain any losses that they may get in the equity market, but they've also got a long time frame as far as earning power goes. They're coming out of school in their early 20s. We're talking about 70 for retirement. I severely doubt that 70 is going to be the retirement age when 50 years from now. It keeps getting pushed out, pushed out, pushed out, and so
now I'm going to put you on the spot. Some of your more advanced students, would you put them in an equity, or would you tell them to get into different types of options? To
I don't encourage them for anybody for their retirement savings to use derivatives.
really?
Derivatives are for individuals. If you want some sort of derivative type exposure, there are ETFs that you can buy that um, basically collar the S&P 500 for the next year.
Okay.
They'll sell a call and they may buy a put spread, etc. So if someone is concerned about the overall market, sometimes I'll encourage them to take a look at one of those types of instruments. The derivative space for individuals, uh, I think the actual proper use is more speculative,
Okay.
almost like, and I've started hearing this term pro retail, and I like to use advanced retail as well. But there's a certain niche of traders that love to trade options every single day. Uh, and I think we all know one or two of them. But within your retirement account, that's supposed to be long-term focused. And in fact, myself, you would think that with my background that I would be heavily involved in the option market, not for my retirement account. I have a speculative account that is my risk capital that I do the fun things with options and volatility and things like that in. So I really don't encourage them to trade their retirement account like that.
Okay. And as I, as you're talking about that, I also want to make the caveat, it's also a little harder to trade options in your retirement account. And
And
that's done.
sometimes they threaten to not allow it anymore,
Mhm.
which not a
Right.
good
No,
idea.
I also I agree with you. I also am a big favor of freedoms and the right to make your own decisions. A lot of 401k platforms now have taken away quite a bit of those rights and made those decisions for you. I don't necessarily agree with that, but that's a totally different discussion for another day. Other comments about this slide?
So just I wanted to throw the 100 minus the age in there,
I like
um,
that.
just because I've heard that one as a rule of thumb in the past.
It's a good rule of thumb. So again, just a different way of thinking about how to split it up. And this is also looking at risk tolerance. So we're moving away a little bit from not only your age, but your appetite and your ability to take on that risk.
In fact, the CFA program, when you're learning about managing money for individuals, you really should start with somebody's risk tolerance and then back into the best returns that you can get for them. And I think that's why risk was the first thing. The risk tolerance was the first thing on that graphic. Um,
Sure.
so
And speaking of risk tolerance, I think it's something that's difficult to actually model.
there's too much of a subjective standpoint around
Mhm.
it. I know a lot of wealth managers will almost use a worksheet to try to back into what they think the client's risk tolerance should be. More often than not, what a client thinks they can do risk rise and the reality, there's a disconnect there. Sometimes they can take on more risk and they don't want to. If I always like to use the Don Draper example. When Don Draper got busted by his wife for being a different person with not a whole lot of means when he was growing up, she just makes this side comment. Well, I thought it was weird that you were never really good with money.
Mm,
And I think there are, a lot of people, if you were not educated around it as you grew up, if you weren't really around it as you grew up, your perception on what kind of risk you can actually take on is likely very different than what you can really do. And sometimes you don't want to lose any money at all ever, and that's
right.
not reality. And a good wealth manager will explain that to you and kind of explain what your true risk tolerance is. But it's subjective. Much like you started out talking about the economics and starting to look at people as individuals, it's exactly what the wealth manager should be doing.
Well, and even I like how you said the wealth manager is going to explain it to you. Just because the wealth manager explains it, and they could explain it very well, doesn't mean the individual is actually ready to hear it and to understand it. So even when we talk about some of these different asset classes, it's hard sometimes for a lot of people to wrap their minds around where the risk is and what the dispersion of returns really means and how that can impact their portfolio. And that's something else that's just a harder concept for a lot of people. And I know a lot of people who like to put their heads in the sand and say, I don't understand, therefore I'm not going to think about it. And if you are one of those people, I would highly recommend a wealth manager, a CFP, certified financial planner. They will look out for you. They have known many people who are not comfortable with these decisions. And this is a worthwhile way to ensure that you're making good decisions, especially if you're uncomfortable around these specific topics. Um, so this was another asset allocation model that I found. And I liked it because again, we're speaking about closer to retirement. And this is breaking down by 60s, 70s, and 80s, because I do appreciate how you've commented a couple of times. Our retirement age is going to continue to be pushed off, especially as we're living longer and we're living better, longer lives. We're in a situation where we need to be thinking about longer term growth and abilities to pay for it. And unfortunately, it's something that Dr. Rowe and I have been discussing also for another type of project is uh, financial fraud for seniors. One of the major costs associated with retirement is your health care. So making sure that you have not only enough to live on to sustain your lifestyle, but really to be able to cover those health issues that could come about is really important. So in this model, I think it's interesting that even at 80, 20% of your asset allocation should be in stocks, because again, you don't know what your healthcare bills and needs are going to be. We all have these great dreams, or at least I have this great dream that I'll be in Hawaii and I'll be surfing, and then it'll just happen and I fall into the ocean, and the ocean will take care of my body and there is nothing left to do. Most likely a lot of us are going to be in the hospital, and there's a lot of costs associated with that, and making sure that your estate has enough money in it to cover those so that you are comfortable. And even at 80, this particular model is only recommending 30% in cash, which is different than some of the other models that we were looking at. So again, if you're looking at a financial planner or wealth manager, understanding their worksheets, as Dr. Rowe put into it, are described how they come up with your risk tolerance is going to give you a better idea of what type of targeted asset allocation they're going to have. Okay. And so now we're moving into the wonky environment, which has been some of our favorite topics. This needs to be addressed if we're thinking about retirement in the next 5 to 10 to 20 years, because our yield curve is different. We're not in a traditional yield curve. So we expect that the short end of the yield curve is going to come down. We expect that the 3 and the 5 year is going to come up. We expect that the 10-year and the 20-year are going to come up. We expect the 30-year to come up. So understanding how to adjust, especially if you are, let's say, in your 60s, late 60s, early 70s, and the recommendation is 35 to 50% bonds, which bonds are you placed in? So this is looking at a US Treasury bond. This is a US Treasury yield curve. This would be a normal Treasury yield curve. If we're looking at a corporate bond, we should have a premium, but it should mirror what the treasuries are doing. And then you get what's called the spread between the two bonds. And you're getting that premium because there's a higher risk that the corporation will default compared to the US government. So then I'll throw this question to you. When we're thinking about some of these for retirement, My thought, particularly with some of these AAA bonds, is that those are still safe for investment decisions for retirement, that you don't necessarily have to be in a treasury product to get that safety of that return.
Certain um, level of core. Yeah, I would almost think of them as like Warren Buffett type stocks, but the bonds
Mhm.
on those stocks. I mean, Coca-Cola is not going to stop making, uh, you know, coupon payments on their bonds. Ford might, if we get
Right.
into a big recession and you've got a cyclical company there. I don't think the return's very good, but I know Apple has bonds that are already the asset that is backing them is cash. So, so you're going to get paid back on that. But yeah, there are just certain Buffett type companies that we expect that are, the titans in the United States that are going to be around, should be around past our lifetime. And those are the kind of bonds that you might look at to do a little bit better than investing in treasury securities because the I mean I and there are big companies. I'm sitting here going through companies that have underperformed in 2024. Boeing is a big company that's got an awful lot of problems. So you can't just do a blanket, I'm going to buy a large company's bonds. You definitely want to take a look at more defensive type companies that have something everybody's going to need, and the company will continue to generate cash regardless of what kind of market environment that we're in. So, American Express, Coca-Cola, maybe even some of the big oil companies, as long as we don't get some sort of big drop in the oil price. But yeah, you don't. We always talk about treasuries as the bond, what we would invest in bond wise. But AA and AAA corporate bonds will give you a little bit better return, a little bit more yield, and your safety level is the same as U.S. bonds. You're gonna get paid back on those.
That's one of my, I taught a class all about coming up with the probability of default for some of these bonds. And a lot of the models that you develop to calculate that probability of default, they're very challenging within the AAA and the AA because we don't have enough companies that actually have defaulted and had a AAA rating.
Yeah,
So the
yeah.
model becomes almost meaningless because we don't have enough, there's not enough sample size where they actually defaulted. And remember those AAA and the entire rating system is really based around financial health of the firm. So all those financial ratios and the financial analysis, that's what feeds into those models. And then like at a Moody's or Fitch or an S&P, they would also calculate what are called these probability matrices to see what is the probability of an Apple dropping from a AAA to a AA. You don't have the probability of Apple dropping from a AAA to a junk bond or Apple going from a AAA to default.
Yeah.
So when we think about some of these, particularly when you're at the AAA or the AA level, those companies aren't going to fail in the next couple of years. We're not talking 50 years from now, we're even 5, 10. We don't have enough data for companies that actually have done this. And getting back to 2008, sorry, back up on my soapbox. Part of our problem with our models, we always assumed that people would pay back their mortgages because people did. That was behavioral finance prior to the early 2000s. People always paid their mortgage. And then we now had an environment where that was no longer true. So as long as that doesn't fundamentally change, these should be very, very safe companies to our bonds, particularly to invest in, and not marginally riskier than what a treasury would be.
Um, this we're talking in late November, and it's kind of the end of fall investment conference season.
Mhm.
And I go to a couple of high-end derivative ones, I go to a couple of wealth manager ones, and I go to a quantitative finance one. And at all four of the conferences that I attend, there were sessions about bond ETFs,
Mm.
the growth of bond ETFs. There is, I think the ticker is LQD, which is the basically double A, triple A, or something like that, bond ETF. But you can get bond exposure in your own retirement account by using ETFs. I recently got long, and you know this, I recently got long treasury bonds because see that bump with the 20-year up there relative to everything else?
Mhm.
Uh, when that comes down relative to everything else, the price of the bonds goes up and I make money on the ETF, and I feel, and I'm kind of playing a reversion to the mean as far as the yield curve goes. So you can use ETFs to get all kinds of bond exposure, and the ETF industry, they're really counting on 2025 being a year where you get to see a lot more of them, a lot more that maybe implement strategies, etc. But making it and that way you don't have to go out there and search for a bunch of double A and triple A corporate bonds. You can invest in an ETF that does that on your behalf.
And I'm glad you brought up the ETFs. That's an easier way to get into the bonds. So other than having enough money to actually purchase a straight bond, which not necessarily every investor has, this is a really easy way to get into a liquid version of those bonds. So when you invest in an ETF, remember it's just like investing into a stock in the idea that it's traded and you're going to be buying what's most likely going to be a fraction of the cost of the entire bond. So it's much more liquid, much easier to get in and out of this asset. And you don't have double taxation from your mutual fund. Can't stand double taxes. Okay, wonky environment. So we talked a little bit about the bonds. So we looked at some of the targeted asset allocations, and even at 80, some of them are recommending stocks. We have a wonky stock environment. So this is the last 6 months, and you can see we've had some major choppiness, so to speak. And for the next foreseeable future, this this trend, obviously we're not for making predictions here, but this trend could continue on, especially given the environment that we have. So when we think about our asset allocation, perhaps some of those older models of encouraging us to be in stocks at this moment might not be the best move for those individuals nearing retirement.
Futurecast and the Roadshow, one of the pieces of feedback I got when I was doing the Futurecast Roadshow for Kelly was that Goldman Sachs, and then I heard this again on Bloomberg TV, so therefore it must be true. But apparently Goldman put a report out saying that they expect the long-term average for stocks to be about 3% a year for the next decade. And I can see that
Yeah.
because we are at a very, I mean, we're at a very high valuation level for the equity markets.
Hmm.
The Schiller PE is like in the 95th percentile or something like that. And as I sat, and that's another reason that I decided to shift into bonds versus stocks. I'm 13 years from retirement, 70 years or so. I, I, and what would make me flip back into stocks is if we get a 20% sell off in the S&P 500. That's really what I'm kind of sitting around waiting for. If something like that happens, there's a good chance that it's going that everybody's going to assume the Fed might get more aggressive on cutting rates, which would be good for my bond position. So,
Hmm.
again, we're closer to the markets than a lot of people. That's probably a much more active strategy than 99.9% people should take a look at. However, when you had a couple of years of the S&P 500 up 20% a row in a year, and maybe you've only got a couple of business cycles left before your retirement, you may want to take some profits on that
Right.
and shift into something that's lower risk but also has a lower return. Because one of the reasons that as age goes along, we're supposed to be switching from stocks to bonds, is our risk tolerance is going down because our earning power, our earning life is going down. Um, so that's just something to keep in mind with respect to asset allocation as well. If we're at a an all-time high on the stock market and you're within, especially if you're within 5 years of retirement, you may want to give some consideration to de de-risking yourself and shifting from stocks to cash, stocks to bonds, either of those assets, which would may hold up better than stocks if we get any sort of slowing of the economy or sell off in the stock market.
And it's also interesting, part of it is what are your goals? So if you are looking to really build up generational wealth and so if you've assumed, let's say that you've got enough money and now you've got an extra piece of your portfolio that you're thinking, okay, well, I want to be aggressive with that because I know that that's what I'm bequeathing to my family, then you may look at us and say, none of this is relevant to me. And this again comes back to the fact that you really have to understand what your personal individual goals are. And that's why it's worthwhile to have those difficult conversations with yourself and with your portfolio manager. Oh, I think this is our last wonky environment. Just also, when we're thinking about getting closer to retirement, we need to think about the impact of inflation. So inflation can be a very, very challenging time period for retirees because they're not making any more money. So they don't have wages that are going to keep up with that rate of inflation. So considering the fact that either they're going to have to reduce their lifestyle, which we're Americans, and that does not sound like something we want
Like
to
that.
do, or having a little more aggressive portfolio to be able to make sure that we're keeping up with inflation. So, and there are uh, bonds that protect against inflation, TIPS, Treasury Inflationary Protective, I
Securities,
can't remember the S,
securities,
securities, thank you.
Treasury inflation protected
Like
securities.
securities.
Okay.
We haven't talked about municipal bonds, but those are also tax-free bonds. So I was speaking to one of my colleagues, and we're talking about municipal bonds and the idea of investing in a local government to receive those tax benefits. Now, you have to really understand your local environment. We're from the Chicago area. Chicago doesn't have the best credit rating, so they would be theoretically more risky. So really understanding what municipal that you're buying and that risk level. Keep in mind that there have been cities that have technically gone bankrupt, which means you're not getting any of your money back. But if you do get into a high quality municipal bond, you did get that tax benefit. So when you start to do some of those comparisons for the rate of returns, when you're thinking about a treasury or a corporate bond, you're going to be paying taxes on those returns compared to a municipal bond. And given that the environment is favorable to bonds at the moment, that is something that's at least worthwhile. Before, when we were closer to zero, it wasn't such an exciting story, but now there's areas and room for discussion for this.
With respect to the inflation thing,
Mhm.
and this is I love it when something pops in my mind when I'm just sitting here. But when in the CFA program, there will be essay questions. Joe Blow wants to retire in 5 years. He needs $10,000 a year in retirement for 20 years. No, he
Mm-mm.
needs $10,000 in the first year. He
Right,
needs $10,200 in the second year. That's 2%, right? But I've never seen somebody account for inflation
right.
when they do the retirement plan. I've even been guilty of that. I'm like, all right, I'm going to retire at 70. I think I might make it to 90. That's 240 months. How much do I need a month? And I always use the same number a month. Um, really, if if you retire at 70 and you live to 85, I will guarantee you that my Diet Coke budget will go up between over those 15 years. Just my regular expenses. And I honestly think one of the underlying things that had a lot of people frustrated with the current administration and has resulted in Trump winning once again, I actually think part of it is what we're looking at right now. A lot of people live on fixed incomes or have incomes that did not keep up with that spike in inflation that you're showing back in 2021, 2022. So, and if we get that again, all bets are off with respect to your wonky and market environment. It, and I'm afraid that might happen.
Well, and
Typically, we
again,
do get it twice.
we've been so spoiled,
We have
decades
been.
of
Yeah.
low inflation. I
Never
remember,
really, you've never really experienced it.
nope,
I'm, it'll be shocking for people to know this, but I am a bit older than you. I turned 16 in 1984. And when you're reaching the 16th birthday and you're working summer jobs and everything, what you're doing is trying to save up for a car.
right.
And I would see cars go up year over year, 10%. It was just, I mean, it was ridiculous. I was like, I'm never going to be able to buy a car because, I'm in high school for one, and I'm not making money 12 months out of the year, but I was never going to be able to buy a car if inflation had kept going the way that it was going in the early 80s.
Well, and yeah, and it's so funny because I had the opposite experience. So most of my driving and buying car experience, I've not only did prices not go up, but I had a
They come
0,
down. Yeah,
well, yeah, and a 0% financing environment. So when I bought my car recently, and it's like, what do you mean there's a rate of, that, and it was because for what, 10, 15 years, we had almost 0%. So not only do we not have inflation, but money was cheap. And that's very, very different than the environment that we have now. And that environment's not going to change overnight. As we've talked about in the animal spirit, we've talked about in the future cast, a lot would have to change with our entire society for those things to change. And they're not slowing down. It's one of the reasons why the Fed hasn't aggressively started cutting rates. The economy weirdly has not slowed down. People are still spending money. So
even if
having
they
said
don't
that,
have it. Sorry.
even if they don't have it, wonky environment, we've got President Trump coming in, and we still don't know what he's going to do. We can speculate until we're blue in the face, but it doesn't change the fact that we don't really know what he's going to do. I think the markets are settling down now that we've gotten the news and we're kind of embracing it. But until he's in office, until we see those first 100 days, we won't really know. Are you doing a President Trump cheer there?
Pop dance.
Trump, Trump?
No. You have to see that he's been doing that on the stage.
Oh, gee.
The Trump. Everybody's making fun of him about it. We got to
Well,
get you on
we
social
should.
media. So
Now,
yeah, that's everybody. That's how people are making fun of him now. So I'm making fun of him. So.
he kind of looks like the flosser from the TV show Bluey. Um, did you see in yesterday's game where Simone Biles' husband did a victory for what did he do?
Got
Uh,
he recovered a fumble.
Fumble. Yep.
Yeah.
And he did one of her poses.
Oh,
Nice.
did he?
Yep.
I didn't even notice that. Simone
So,
Biles is the Bears Taylor Swift.
mhm. So we love her.
Even if she wore Green Bay Packers stuff to a game once.
I know.
I
I
know.
know. We just don't talk about everything.
No, we don't. So.
Okay. So now we've started talking about this of what do we do? And we talked about some of these issues. We talked about whether or not the S&P was at the top. We're concerned about some of the downside risk. We're concerned about some of the global factors right now. And we haven't discussed this much in our podcast, but there are two major wars happening. Um, that are currently occurring right now, and again, getting back to individuals, these are individuals who are fighting this, um, which is, I get, and no matter what your view on who's right and who's wrong, there's still individuals that are in this, and that's not okay. But those risk factors are going to have an impact on what happens in the financial markets. We talked about the bond market, whether or not we should be in corporate or government bonds. And then also, and I think this is our last slide, but as we're nearing retirement, I really also wanted to talk about the housing environment. So one of the things that's been discussed uh, in the last, I think maybe year that I've heard it, it's probably been talked about much longer than that, but this incredible wealth transfer from the boomers to the next generation. And part of that includes the house. So if you think about your retirement, your entire wealth package, you've got your, hopefully your IRA, you've got any pensions, and you've got Social Security, and then hopefully you don't have a lot of debt left on your house. So then the question has to be asked, what do you do with the house? Do you try to sell it in this environment right now? Because we've got overinflated houses, nice prices, but we also have higher interest rates, which in different pockets of the United States, some markets are slowing down dramatically. Some markets are still very, very hot, but there are other markets that are really starting to temper. So, and then if you're nearing retirement and you get rid of your house, do you buy another house? Do you get into another mortgage at these high interest rates? Do you try to pay cash? Do you rent? So those are also some of those questions that need to be like almost like a puzzle that needs to be implemented into your overall strategy. And my parents have just entered retirement, and I can say medical insurance is a lot bigger deal, and there are a lot more questions associated with this than I had any idea. So this is also something really important. And if you're somebody who is uncomfortable with these things, I would highly recommend seeking out professional advice, because those are real potential problems that you want to be prepared for. And I think that's it. I think that's all implementation, one more. So any changes that you have to your 401k, changes in your IRA, individual retirement account, your medical insurance, and then possibly needing to downsize your house. The other weird advantage of downsizing your house is you will reduce the maintenance that is required substantially. About 5, 6 years ago, we went looking for a house, and I saw lots of houses with that it was very clear that he had senior citizens living there, and the house had started to decay because the people who owned the house couldn't afford the upkeep. So if it needed a roof, they just did not buy a roof. Things like that started to decay. So if you're in this situation, you really want to think about what your housing needs are going to be in the next 20 to 30 years.
Do what I'm doing, right?
What are you
I'm going
doing?
to live in a Hampton Inn that's in a mall parking lot. That's my plan. So
Oh,
that is
let me get that.
that's totally my plan. Is no, I read an article once that the retirement home where they're not really taking care of you, um, that you get the equivalent at a Hampton Inn for about $3,000 a month.
Wow.
They'll clean your room every day. They have free breakfast. And if you stay at one in a shuttle, you can just go be a mall rat all day and then come back and they'll have cleaned your room for you. And if you bribe the housekeeping people, they may do your laundry for you as well.
I
And it's
I can
cheaper. It's cheaper than, like a retirement home.
I've read about people moving on to cruise lines and doing the same
Oh
thing.
yeah, yeah.
Mhm.
Um, there's one that's, I think it's like a 3-year voyage that you can just
Wow.
hang out on. I don't know if I'd want to do that. Um, so World War III will break out. You'll be in the middle of the Pacific, and you're going to be the last great hope for humanity.
And there'll be a bunch of retired
I know, really
individuals.
coming up with a strange one there. So, all right. Well, we dug a lot into retirement. I actually made some notes on some things I got to check on mine. It's an area that we talk about at a very high level in the classroom, but I think before we were getting started, we were talking about how some of the things that we teach in the classroom don't translate fully to the work world. It's like we give you the basis, but much like the inflation thing that I just threw out there, I've talked about saving for retirement, used retirement examples forever. I always say, and now we've got $8,000 a month for retirement for the rest of our lives. But that $8,000 today, we're in 2024, $8,000 ain't going to buy as much in 2044. I'm certain of that.
And really,
We're not supposed to make certain statements, but I'm certain of that one. So,
yeah.
just another thing to kind of keep in mind. Don't live check to check in retirement. Make sure you got a cushion in there for sure. So, well, with that, for Dr. A, I'm Dr. Rowe from the Kelly School. We appreciate you guys spending some time with us, just talking about some of the things you got to know with respect to asset allocation as retirement approaches. A lot of things that you got to think about there. I'm going to steal Dr. A's line. If you like this, please hit the like button. My kids are 18 and 20, they could care less, but her kids look at that and
They
they
get
think it's really neat. So, feel free to go. And if you've got something you want us to talk about, feel free to just put it in the comments below. We're happy to take those comments below and maybe turn them into a new video. So, with that, we're going to let you go about your day, and we will be back in a week with another really fun topic.
happy Thanksgiving, everybody.